What is a stock? A stock is a share of a company whose owner has a right to claim a part of the organization's assets and profits. Everyone who bought a share becomes a shareholder and therefore co-owner of this business. The size of the share is determined by the number of shares owned by the investor in relation to all existing shares of this company. For example, if a company is divided into 1,000 shares and one investor owns 100 shares, then he claims 10% of the company assets and profits. Companies issue and sell their shares in order to raise funds, mainly for business development. On the other hand, investors buy shares of companies in order to generate income. There are two main types of shares: ordinary and preferred. Their difference is that ordinary shares give the owner the right to vote at a meeting of shareholders, while preferred shares, as a rule, do not. On the other hand, preferred shares take precedence over ordinary shares in the payment of dividends and in the event of bankruptcy upon receipt of funds from the liquidation of the company. Part of the net profit to be distributed among shareholders is called dividend. However, not all companies pay dividends. This is because the profit received is invested back into the business, which should stimulate the development of the company. At the annual meeting of shareholders, the amount and frequency of dividend payments shall be established. In most cases, dividends are paid 1 to 4 times a year. Shares are bought and sold primarily in the stock market, although private transactions are possible. An individual or legal entity can open an account with a brokerage company and gain access to the stock market for the purchase of shares and other securities.